So, welcome back. So, in previous video, we discussed about income determination in three-sector model, and then we went on to derive government expenditure multiplier using the equation of income determination with government spending and taxes. In this video, what I want to do is derive the tax multiplier. So, tax is basically nothing but withdrawal from circular flow of income. So, if tax is withdrawal from circular flow of income, it must be a negative effect. It must cause negative effect on equilibrium level of national income. So, in order to find out the tax multiplier, which basically tells you that by increasing taxes by certain amount, how much impact it is causing, which is of course negative impact, it is causing on the equilibrium level of national income. So we will recall this previous equation that we used to find out the government expenditure multiplier. This equation right here. I'm going to rewrite this equation here. Let me just put a heading. Okay, tax multiplier. So we'll use this equation, y equals a, y equals, sorry, not a, 1 over 1 minus b times a minus bt plus I plus g. Right? So in order to find out the tax multiplier, we are going to use the same logic that we used to find government expenditure multiplier. In government expenditure multiplier, we increased G by a certain amount, that is government expenditure by a certain amount, and which will of course cause some changes, some increment in national income. Okay, so here we will do the same process. So we will increase T by certain amount, let's call it delta T. It will cause some changes in the level of income, which is, let's say, y plus delta y. Alright, so let me introduce all these changes into this equation. So y equal to leaving some gap here, 1 over 1 minus b times a minus b times t plus delta t, this is the changes that we're concerned about, plus I plus g. Okay, so I already introduced this delta t will cause some increment here, delta y, okay, delta t. So let me just rearrange this equation. Y plus delta y equal 1 over 1 minus b times a minus bt plus b delta t. Sorry, not plus. Again, I'm making silly mistakes here. So this is going to be minus plus I plus g. Okay. Now, previously, while deriving government expenditure multiplier, I subtracted the original equation with the new equation. Okay, I'm going to do the same thing here, and what we will be left with is only the changes that we are concerned about. So here I'm going to subtract y. Okay, y equal to 1 over 1 minus b times a minus bt plus I plus G. Alright, so the common term will get cancelled out, and what we will be left with is delta y is equal to 1 over 1 minus b times minus b delta t. Okay, so I'm going to bring delta t on the other side of the equation, and we will get delta y over delta t is equal to minus b times 1 minus b over 1 minus b. Okay, so this is basically what we call tax multiplier. So this is tax multiplier Tm, denoted as Tm. Okay, so the negative sign, that you're seeing here tells you that the increment in taxes, the changes in taxes will cause negative impact on the level of national income. Sorry, let me just correct myself. The increment in the level of taxes, lump sum taxes that we are talking about, will cause a negative impact on the level of national income. So in the next video, we will talk about the balanced budget multiplier. So basically, we will be combining the government expenditure multiplier and tax multiplier, and we will determine the balanced budget multiplier. So which we will prove that when changes in delta G, right, delta G, which is changes in government expenditure, is equal to changes in the level of taxation, the budget multiplier will always going to be equal to 1, and I will show you that in the next video. Thank you.